Hey, you know who probably drove this decision, CJ?
Who?
The CFO.
Can't live with him, can't live without him. It's so liberating to get to a point where you don't have to take meetings with people you don't want to take meetings with anymore.
The Wealthfront business model, and the Chime business model for that matter, they only really work if the best customers stick around, because the high earners are going to keep having their assets compound over and over again.
You got to bring in the Rob Riggle from Step Bros, like, love the Bips meme where like you say 0.01, so that's pretty small. And you say 1%, it's like, oh no, that sounds tasty. And you say 100 basis points, you're like, now I'm cooking.
But that just told me, like, people take LinkedIn so seriously, and like it's pretty hard to find founders that are not trying to grow their LinkedIn audience.
It's a post about net dollar retention rates, and then it's a photo of just their face in an airport with like some Cracker Jacks.
One of the first things that I encourage folks to think about is like your first step on LinkedIn isn't to post, it's to comment.
From Mostly Media, it's Mostly Growth. Go-to-market strategist Kyle Poyer and CFO CJ Gustafson share smart takes on growing revenue and running a company, pricing, unit economics, AI, leadership, candid insights for CEOs, CFOs, and CROs, or anyone else aspiring to climb to the C-suite. This is Mostly Growth. Oh, wait, CJ, tap your mic.
Am I on?
Yeah, you're great. Awesome.
That's some good B-roll.
That's going in the opener.
Welcome back to Mostly Growth, everybody. I got a hot one for you. Kyle, do you have a dog?
I do have a dog. His name is Chase.
Chase. How ironic. That's like a hit name for a dog, huh? Ben, do you have a dog?
I got a cat, and I think I've used BarkBox for her, so yeah.
You have?
I think so.
Are you reading off the call sheet and giving away my topics? Thanks, Ben.
I also remembered it's not even BarkBox, so...
Ben's... No, we're keeping this in. First of all, Ben answers my question, I have a cat, not what I asked. Second of all, gives away... Kyle, let me ask you something. Do you get BarkBox for Chase?
We don't. I am too bougie for that.
Is there a more upscale BarkBox?
There is an artisanal dog bakery called Polka Dog that's in my neighborhood, and my dog actually like takes me on a walk to Polka Dog. We cannot walk by without him going in there, and we buy at least one treat. It's kind of like a candy store where you can just like take a bag of the treats. So we'll get at least one treat, and we honestly get toys way too frequently.
Do the dogs in the neighborhood lead all their owners towards it? Like they know where it is, they can smell it?
I mean, the fancy dogs do.
We're not nearly as sophisticated, and we get BarkBox, but something has changed, Kyle. BarkBox has become Bark Bag. My dog Walter, the highlight was he would be able to smell that it was his package because it had treats of some sort in it, and he would rip it apart with his teeth, and it was the highlight of his month. It would come once a month. It would come in a cardboard box. They've since moved to a bag. I feel very strongly that it goes against the ethos of getting a subscription box with box in the name, and it now comes in like a cheap plastic FedEx bag.
Oh, wow. If you look at the website, it does just call itself Bark now. So they rebranded. This needs to have the attention that the Cracker Barrel rebrand had. This is like a Cracker Barrel level rebrand mess up.
I can't imagine that the change in unit economics, though, would be so substantial that it's worth it to do a complete rebrand to save 0.0% margin on moving from a recyclable, crappy cardboard box to a plastic bag that is bad for the environment.
Hey, you know who probably drove this decision, CJ?
Who?
The CFO.
Can't live with him, can't live without him.
Who else made that decision for them?
Honestly, can you imagine that phone call, the CFO, like to the CMO, like, hey, Jim, we got to make some big changes around here.
They probably put on the resume, like, saved the company $401,000 by switching from boxes to bags.
I'm probably the one that's wrong. I bet it was like a savings of like 400 million or something. And I'm just understating how big this company is. But either way, BarkBox is now apparently Bark Bag, and we're going to be unsubscribing unless they send us something and they're listening to this.
Partnership.
Ben, all right. Either you or your cat. What's the first topic we got for today?
First up, Somebody on this podcast has become a solopreneur. Now, Kyle, you're a solopreneur now. What could possibly go wrong?
Yeah, we'll see. It's official. So I'm following in your footsteps, CJ. I even have the LLC to prove it to you. Business Yoda, what lessons do you have for a young Jedi like me?
It's so liberating to get to a point where you don't have to take meetings with people you don't want to take meetings with anymore. I think that's the best upside of it. The hard part is figuring out what to do with the next marginal hour of your effort that you can put towards something. So there is the element of having this set schedule where you have to produce at these increments, right? We're producing twice a week. Your newsletter now, it comes out once a week. It may come out more frequently than that. And so that gives you some structure, but it's like, how do I fill up the rest of the day? And then also, as a CFO, a lot of the things I worked on weren't inherently creative as much as I would like to chalk up my operating models and RevRec as to a work of art. I could grind through those at 11 p.m. And we've talked about this in the podcast before. 4 p.m., not many good newsletter posts coming out. That's a different way that I have to structure my day to make sure that I protect the morning hours. So I make the main thing the main thing. So the time management, it's both liberating, but also scary of how to plan out what am I going to do here and how am I going to make money.
Yeah, I mean, the cool thing is that I'm only limited by my ambition and what I want to work on. The downside is that I kind of want to work on everything. So maybe I'll need to go 996 myself. I could be part of that ramp chart that's expensing, lunch on Saturday, part of the 2 burritos. I think the biggest thing for me is everyone talks about the freedom of being your own boss. Nobody talks about the admin, and it turns out I'm not so great at admin.
I'm trying to hire for a new admin right now. So if anybody else wants to run operations at Mostly Media, a booming empire, and hang out with me and Ben, you should do that. It's a suffocating amount of admin, I'll put it that way. And it's coordination with other people. It's calendar invites. Calendly just is not doing the trick for me at this point. And what you said about wanting to do everything, because you do well in something and you start to get some traction, you get all these other things that are shiny that come your way. And I was always the person at companies before, like, no, we have to stay focused here. We can't just get pulled into things because we had some modicum of success in this. And now, I don't know, like, Kyle, are you going to get like a book deal or something? Like, weird things pop up. You get asked to speak different places. You get asked to invest in different things. It's kind of like you have to, I don't know where I'm taking this, but you suffer under the own expectations you put on yourself, but also the expectations I think that you kind of absorb from others to get involved in stuff.
I definitely see that, see the beginnings of it at least, but I'm not even that far along. I'm just at the basic admin levels. CJ, this is the thing. You have forgotten all the things that I'm going through right now because it's been so long. But this is an example. I wanted to figure out the fastest way to just register as an LLC. So I did Stripe Atlas. It just automatically tells you Delaware LLC. It's like, sure, that sounds great. Then I found out that Massachusetts requires me to also register in Massachusetts. So it's an extra $500 fee and there's an annual fee. So I now just am double registered. And of course, you can't register online because that would be too simple. And my first Massachusetts registration failed because the form needs visible signs of pen on ink on the signature. And my signature did not have enough visible signs of pen on ink. That's literally the reject description.
You need a wet ink signature for this, Kyle?
I think I need an officiant. I need to find a, wait, what do you call the person?
Notary public?
No, notary. That's what
Yeah.
I need. I need a notary. I am scratching the surface. I keep making so many dumb mistakes. And I'm like, if I just could find someone that's done this before and pay them to do all the admin for me, I'd be so much better off. I am discovering some fun facts though. I've
What?
discovered that I could put way more into my 401k than I thought I could possibly do. You
Yeah.
must know about this, right?
70.
Yeah, that's a lot of money to put into a 401k. So there's some advantages to solopreneur life, but I feel like I don't know enough to figure out those advantages.
We can cut this if you don't want to keep it in, but have you decided if you're going to pay yourself payroll or if you're just going to take dividends or distributions out of the company?
See, these are all the things I need a CFO to tell me what's best.
Yeah. If I find one, I'll let you know. It sounds like a problem or it sucks.
These are the things I don't want to handle, and now as the only employee of my business, I'm the one who has to figure it out. I like to say yes to the shiny things, and I don't like to do the admin work.
Honestly, the part that sucks the most is having to estimate your quarterly tax payments and submit them. Oh, we're only in. You haven't had to go through a quarter yet. You're gonna have to
Oh, no,
estimate.
the quarterly things, I have submitted those, but the weird thing is they're not quarters. Like, one quarter will be 4 months, one quarter will be 2 months. Like, how do they call them, like, quarterly estimated payments, and they're not even quarters?
If you're a tax professional who wants to sponsor our show and also give some friendly advice, please reach out.
So next up, we've got the Wealthfront IPO, where CJ, I believe you did a S1 breakdown of them.
Before you do that, CJ, I have a question for you.
Hit me.
Who the hell is Henry?
Henry. Where?
You talk all about Henry in your piece. Tell me who Henry is.
Henry? What are you talking about? In the Wealthfront piece?
High earner, not yet rich. That is like the number one thing that stood out to me in your S1 breakdown. Like, am I Henry?
Oh, you got me.
Is that the new dink? Dink used to be the term.
Yeah. That's
Or yuppie.
double income, no kids.
Yeah, or yuppie, young urban professional. I don't know what the rest of that stands for. But is Henry the new dink?
Henry is the new dink. It is. They're basically,
All right, so Wealthfront is for the Henrys of the world.
which is so fascinating because Chime was for people making up to $100,000 per year, another company that recently went public, another fintech company. This is for the people who are making, on average, they said $165,000 or more. So they're going after a very targeted niche of Henrys, like you said there, Kyle. So Wealthfront, on the surface, way smaller in revenue than we've seen. They're at $339 million in revenue, but they have 46% EBITDA margins. So I'll say that again. Almost half of what they touch is going to the bottom line. I was reading through and I did the Control F, and they mentioned the word automation or automate an astounding number of times, over 70 times throughout the piece. And so this company is basically a robo-advisor. It allows you to sock away money, like we mentioned, 401k plans, and also take other financial actions to save for the future. And they're making a bet on high earners who are not only thinking about their future from like what they will make, but also what they'll inherit from all the baby boomers who at some point take a dirt nap and pass on money to their kids. They're positioning themselves as like the anti-bank. And this is where our lawyers would say, you have to say they actually aren't a bank. They're a financial technology company like a Mercury or a Chime. But I think this is really interesting because it's testing the lower end of the IPO market in terms of how big you have to be. And previously we said Navan was doing that, right? Around 630 million in revenue. They said, hold my beer. We're not even at 400 yet. We're going to try to go here. Now the efficiency metrics look great, but Kyle, what's your read on this?
Well, yeah, so efficiency metrics are incredible, and that's a big difference with Navan. Plus the net revenue retention figures were quite high, especially for more of a consumer company. And so while it's a business that is on the lower end on the revenue side, it feels like durable revenue and a highly efficient business. And you had said, not to, quote you, but you had said that there's a lot more appetite for smaller companies if they're highly profitable.
Did you see what their rule of 40 was, Kyle?
I did not. What is it?
71.
That is not too shabby. That's like Palantir level. Not quite Palantir, but pretty close.
And their revenue per employee is almost $1 million. To put this in perspective, I recently did write-ups on Netscope and Navan, who were the most two recent to file to go public. They were both around $150,000, $200,000 per employee. Wealthfront, while smaller, is 5 times or more efficient on a per employee basis. And their rule of is almost double what a rule of 40 would be. While Netscope and Navan we're trying to climb that ladder to get there. So maybe the market is just it's ready for great companies, okay? And this company isn't growing as fast as it used to. It's fallen into the 20% for growth, whereas the year before it had grown in the mid 40s, and the year before that it had grown like 150%. So it has decelerated. But if you're thinking about this, is this going to be a stock that compounds over time along with this niche of Henrys that they're trying to lean into and get into as a customer base? It makes for a fascinating one. And I think it also is kind of the canary in the coal mine or a leading indicator for some of the smaller companies that we knew had slowed down during the 2023s after raising a ton of money in 2020, 2021, and are probably stuck around that 350 to 450 revenue range.
So one of the things that stood out to me reading your S1 breakdown here was their pricing model. And while they're a fintech company, I found their pricing model pretty interesting in the age of AI. And so a bunch of AI companies are claiming that they disintermediate the middleman, right? They take on being your accountant or your lawyer or your customer support agency or your SDR. Wealthfront is kind of saying we're that, but with old school wealth managers as the equivalent. And they're saying that, tech should be about 75% cheaper than people. And so I found, typical wealth managers, old school wealth managers would take about 1% of your assets as their fees. Wealthfront charges about, 0.25% advisory fees. So 75% cheaper and just as good of results, and all digital, all on your phone. That's kind of the pricing model that a lot of AI companies are coming up with too.
It totally is. I love how you connected that. So you take 339 million in revenue on 88 billion in platform assets. That works out to 38 basis points. I love the bips meme where like you say 0.01, so that's pretty small. And you say 1%, it's like, oh, no, that sounds tasty. And you say 100 basis points, you're like, now I'm cooking. Then you get into
When I
bips.
got my first VC carry grant and they told me the number of basis points, I was like, wow, I'm going to be so rich. And then you do the math, you're, oh, maybe not so much.
Yeah, you got to work out a couple decimal points there. But they make the bulk of their money on that 0.25% advisory fee, like you mentioned. So either way, 0.25 or blended across everything, 0.38. That is like substantially cheaper than having a human manage your money. The question is, does it do as good of a job? And I don't know.
Well, that ends up being the same question with AI companies, right? So 75% cheaper, and if it can do as good of a job, it's a no-brainer. If the outcomes aren't as great though, right, they don't generate the return for you, then it's not worth it. I think the other thing for me that was interesting is they're positioning themselves as, hey, we charge you 0.25% at 75% cheaper, but then they have other income streams where they can make money on your assets. They're able to essentially advertise one rate and make a lot more money.
But that's what all great fintech companies do. They start out with one way of making money, similar to a Mercury, where it started out as just assets under management, basically what you would get on your cash in the bank, and then you add other products over time, like they added a credit card. And so you stack things together. Stripe has a subscription element to it. It has a processing fee element to it. You had mentioned you use a filing product that they have. So you start with one type of revenue stream or gross profit stream, really, because that's how you have to value these companies. And then you layer cake on the other ones to have more durable revenue.
But tell me this, CJ, do you use a service like Wealthfront, or are you old school?
I'm old school. Terrence called me on the phone today.
And you answered it.
I did. I answer when Terrence calls because I want to make sure my money's still there.
When the money's calling, you pick up the phone.
My Terrence is Todd. I guess if you're a regular wealth manager, how do you compete in this environment? Do you cut costs? Like, do you position in different ways? Like if you got the Wealthfront going after your business at 75% less fees and attracting, kind of a lot of customers, how did these wealth managers stay in business?
Well, you do what he did. He called me today to explain something that was going on. So something happened that I didn't expect to happen. I accidentally got a dividend check in the mail. I was like, that's weird. I'm not looking for like this income stream. I'm trying to let it compound over time. And we talked about what happened. Then we ended up talking about some other strategies that we were going to put the great advertising dollars from this podcast towards. But I think it goes back to having someone to call when shit hits the fan. It's the reason why as a CFO, a lot of times you're willing to pay more for insurance than trying to go through like the B2B equivalent of Lemonade on the B2C side. If a storm hits my house, I want to be able to call someone like a Todd and say, hey, can you help me make amends here or get this stuff fixed? And there's a certain, I don't know if I put like bips on that. I don't know how to quantify that, but having a human that I trust and that I can call and I know that their hand's on the wheel and it's not an algorithm, that is worth a lot to me.
Yeah, I think that personal service element comes into play a lot. And there's an element of tools actually that are arming the wealth managers of the world, right? Of like AI note takers that could then suggest smart actions and help you be more proactive with managing your clients. So like there's a whole like Shopify tried to arm the rebels of e-commerce. Like there's an arming of the rebels of independent wealth managers out there to help them compete against these new tools that I find fascinating. I think the other thing is the Wealthfront business model and the Chime business model for that matter they only really work if the best customers stick around, because the high earners are going to keep having their assets compound over and over again, right? And then those folks are worth, if you're charging based on percentage of assets, like those folks are worth a lot more than your high earner who doesn't have a whole lot of assets. And so Wealthfront has to bet that they can keep those folks on the platform. These wealth managers are going to be trying pretty hard to poach the best customers, and those best customers are really where most of the revenue is.
I had only 2 complaints reading through this S1 that was hundreds of pages. The first was it takes to pay the 6 infographic for them to put their revenue. That's got to be a Guinness World Book of Records for how long it takes you to put your revenue on an infographic within an S1. It was way down. And the second thing was they didn't get to the concentration, Kyle, of what percentage of the AUM is with what percentage of the customers. Because to your point, some of these people also will churn out the top. They'll say, I have so much money now, I'm gonna call someone who's human, and I'm okay paying 1% because I just want to make sure this is safe. And I think there are alternative strategies. So wealth managers can also help you get into IPOs, right? I don't think Wealthfront was going to help you get into, maybe they'll help you get into Wealthfront's IPO, but the reason why people work with a lot of these big banks is because you get access to like a Navan IPO. If a Morgan Stanley is taking them public, some of that will go to their institutional clients. The percentage mix does make a difference. And one macro thing that I wanted to call out, and this impacts a lot of fintech companies, and it's macro and regulatory. So on the macro side, if rates get slashed for a company like a Wealthfront, their revenue goes down a lot, or they have to run the company in a different way that just doesn't depend on that percentage of assets under management. They may have to still promise that amount to keep their customers around, but basically get none of it. So you got to keep an eye out for that. And you saw their revenue boom when rates went up, right? And so it's a pretty good time for them to go public now before rates go down again, if we think that's going to happen. And the second thing is with the regulatory stuff, a company or a bank that's not a bank, such as a Chime, they get to charge a higher amount on interchange because of this thing called the Durbin Amendment. If that was ever changed, then they wouldn't be able to take such a healthy chunk on every time you swipe your debit card. Like Jamie Dimon is at home right now. Like, this sucks. I'm a real bank and I can only charge like 1/4 of what a company like this, who is a bank but isn't a bank, can do. And so there are all these exogenous, and I'm just using that word again because you called me out for it last time, things that can change. I still can't spell it. That can change your business model with these fintechs that are a different going concern than you would have in a typical B2B SaaS.
Taking all that, I think for more traditional SaaS companies or even AI companies, you should watch how this IPO performs to see, the market's appetite for smaller companies going public. But it's probably not the most apples to apples, like a totally different business model, totally different set of risk factors. This is, worth watching, but not worth planning your business totally around.
Nailed it.
It's take private season. We got companies like Couchbase, Olo, PagerDuty. They're going private. What's the deal?
Ben, me and you talked about this on a previous podcast. If you go back 30 years, there were about 8,000 publicly traded companies in the US. We are now less than half of that. There's less than 4,000 that are on public US stock exchanges. And there are a ton of companies, particularly in the tech sector, with juicy recurring SaaS revenue that is healthy, it's retentive, but they've stopped growing from the crazy heydays of adding more seats, depending on more consumption, and being able to upsell or hero sell more products. And so their growth has come down to sub 10%. And these are looking like great buyout targets for private equity firms to come along, swoop them up, take them private, work their value creation playbooks, and then hopefully in 2 to 5 years, bring them public again. So there have been a number of names here that have been actually taken private and a couple that have been floated.
Well, hold on, CJ. So I thought PE firms were penny pinchers, and now you're telling me that they're willing to pay more than public investors to take companies that are already public and turn them private.
You nailed it. And that's because if you check the multiples of what SaaS companies are trading at now, and Ben, you can find it on yesterday's issue from Sunday at mostlymetrics.com, the median SaaS multiple has fallen to below 5x forward revenue. So they're willing to come in, and if it's a company that's only trading at 2.5x, 3x, they'll be willing to pay a premium of 4 or 5x, take it private, and hopefully within 3 years, they can get it to a place where revenue growth has hit a level that's higher, the costs are lower, the free cash flow is higher, and then you IPO into a market where you're trading at least 8x forward. And if you're buying it for half equity, half debt, you're doubling that return that you would have got on the difference between 8x and 4x. So it's a pretty lucrative play if you can do it. You do need the right environment, though, to do it and to be buying at a price that makes sense.
So essentially, SaaS companies are starting to look like bargains, right? Because we're used to them trading at maybe 5 to 8x revenue. Now a lot of them are under that. This strategy, does it ever backfire? Like, it sounds like it makes sense on paper. It sounds logical, but how often does it actually work?
Well, I'll start with when it worked. So SailPoint did this a couple of years back. They were taken private by, I believe, Thoma Bravo, and then they just made their debut back in the public markets about 6 months ago. And so that one worked well because they had a business model change they wanted to make. They needed to go from selling perpetual licenses to SaaS licenses and go to the cloud. And so you probably don't want to do that in the public light, right? It makes sense to go back, make some of these changes, have revenue potentially slow down, look lumpy, and then get healthy and get your metric story right. And they came back at a substantially larger size of a company. And when you do just a simple multiplication of a larger number times a somewhat larger multiple, you get multiple like enterprise value expansion there. But it does backfire from time to time. The thing is, you don't hear about the companies because they never come back to the public lights. What happens is they end up getting retraded to other private equity companies and rolled up that way, or they have a chunk of the company taken out. So Dynatrace is an example of a spinoff of a company that was once public. I think it was called CompuWare, and it came out. And so there's all sorts of ways that you can divide up what is working and isn't working. It can definitely go wrong, and it gets scary if you're using a high degree of debt when you're doing it.
So let's take Vista as an example. So they have a lot of success with this, take private strategy. They, work with the companies, fix up the operations, then take them back public when they're a larger company, hopefully growing faster, more profitable, sexier, better story. What is the operational excellence that, a company can expect from a private equity firm? What does it actually look like in practice?
Well, the first thing is getting better on your negotiations with your vendors. And a lot of times these private equity companies have other portfolio companies where they're bringing so much collective business to them, like a cloud provider. They can get better rates on it. So you improve your gross margin through that. Then there are other value creation playbooks they talk about that are on a department by department basis. So you may have one for customer support, things that they've seen work at other companies that you can implement. And then honestly, Kyle, a lot of it's just bringing in management that they trust and have worked with at other companies. So ripping and replacing the CRO, the CMO, and putting someone else in who is kind of, I'll call it like a company man who can help run the company in a way that's drove results before. So there isn't just like one way to do it. It is difficult to get revenue back up, right? It's a lot easier to run a business for cash when the tide starts to go out. It takes a lot of foresight, management changes, and also M&A opportunities to try to get this thing going again. So a lot of the companies that you see going public again, Solera, I remember in the automotive sector had filed their S1 last year to go public again. They're basically like a Frankenstein of like 74 different other auto companies. And so when they were taken private, they kept adding new M&A to try to get the growth engine going again. That's probably an example of a company that got over their skis with debt in an effort to do that.
Yeah, see, I think a lot of the private equity playbooks make a ton of sense, right? It's applying a lot more operational rigor and discipline around decisions. I do, get skeptical about some of the things they do, though. And I think a lot of it is not really modern for this AI era. Like, I think a lot of them are scrambling to figure out what their playbooks look like in the age of AI. I don't know how many of them have really been successful in totally changing their practices. But I like, for example, I talked to a founder of a company that had experience with Vista Equity, and they told me about the rule of 9 and how part of the model was that the number of years of the typical contract length plus the average annual price increase should be as close to 9 as possible. So like, hey, it's fine to do 3-year deals with a 6% annual price increase or 1-year deals with an 8% annual price increase. Kind of like hey, let's lock in customers for as long as we can and try to just gouge them with price increases. Meanwhile, we'll strong arm vendors, outsource our core operations to lower cost geos, and then bolt on some fast growing products in our suite that we can sell to juice growth. And then we'll have them go public again and no one will be the wiser. Like that's some of the skepticism I tend to bring to these take privates.
And I don't blame you either. It's not just in tech. There have been a lot of Ben, there's this book. It's called Plunder. It's about the private equity industry and the shady things that have happened. And this author is definitely skewed towards saying private equity is the worst thing in the world. And I don't think it's necessarily that far on the spectrum, but some of the stuff around, in particular, healthcare services for the elderly has been absolutely horrible that they've done. Basically, taking out all the costs that was used to keep people healthy. And there were actually people who got sick and died from that. The story that I think is memorable to people who have been involved in like youth sports growing up is there was this big cheerleading brand that private equity took over. And basically they raised the prices so high that it made it impossible for normal people to participate in cheerleading. And that's an example of just taking greed and applying like a mathematical playbook that, yes, does work, but it's a net negative for society.
Yeah, that's where, obviously not every private equity firm is the same. They don't always have the same practices. And sometimes you're force fitting a playbook where it really doesn't make sense for the business. And in the other cases, it's, transformational. And I think that the best examples are where you talked about like the business model evolution, on-prem to SaaS. You're going to take a hit in short-term revenue, but have higher LTVs with your customers. And today, the equivalent, it's not normally on-prem to SaaS. It's like subscription seat-based licenses to usage-based models or outcome-based pricing. You're actually going to see pretty similar dynamics to revenue when you shift business models like that. And I think many companies can take on more risk with business model evolution when they're not having to report quarterly earnings.
And even though they're not reporting quarterly earnings, the rigor around reporting on a monthly and even weekly basis happens. And that's why you usually have to overhaul like the FP&A department. You have to bring in people internally, even if you're cutting costs elsewhere, to be able to report on a more repeatable basis and to look at the metrics that your investors want to look at. But Ben, you can either keep this at the end or maybe cut it in after. But the cheerleading brand was Varsity Brands. And so Bain Capital and KKR went and bought like every other cheerleading brand out there and rolled them all into one and basically created a monopoly and then raised the prices so high that I think it was like 7 times more expensive for a participant to just buy the gear. And they made it so you had to buy the camps, the clothing, the shoes, everything, all through this one distribution channel.
All right, Ben, let's move to happier topics.
All right, so next up, are people getting screwed by the LinkedIn algo, or are they just bad at LinkedIn? I feel like I'm being attacked.
So CJ, tell me about what's your LinkedIn count these days?
I'm still under 20,000 followers. I'm not near the scale that you're at, Kyle.
Not to make this a pissing contest, but a little further along than you.
Did you hit 100 yet?
No, working on it. But so one thing that was funny, when I went and made my solopreneur announcement, I talked about some of the work I do is media work, right? Newsletter, podcast, and then some of it is doing consulting and advising for companies. And a bunch of people just assumed that my advising work is helping founders improve their LinkedIn presence. Like I'm now like a LinkedIn influencer advisor or something for my job. But that just told me like people take LinkedIn so seriously, and like it's pretty hard to find founders that are not trying to grow their LinkedIn audience. And many of them are trying and failing. And so thought it'd be fun to share. I mean, 20,000 followers is really nothing to laugh at. I think a lot of founders would kill for that. And then I've put in my 10,000 hours. So I figured it'd be fun to trade stories about what actually works on LinkedIn these days. The engagement farms, probably not the best thing to do, for example. I've actually been invited to some of those engagement farms where like everyone is going to sign up to it to like each other's posts. Like I am not so into that stuff. So founders are trying to stand out on LinkedIn. I think that there's like somehow every company got the message that like we should all post on LinkedIn. And at the same time, the algorithm has made it so that it's harder for your content to stand out. And a lot of people are finding their impressions drop significantly over what it used to look like 6 months or 12 months ago. And so many people are struggling. There's this thing that they know could be worth a lot of money, but it ends up feeling kind of like a slot machine. And most of the time, you don't win any money from the slot machine. From my experience, like one of the first things that I encourage folks to think about is like your first step on LinkedIn isn't to post, it's to comment. And comments can actually get way more impressions than posts. And so find like 5 to maybe 10 great thought leaders in your niche who are writing thoughtful stuff and set an alert to get notified when they have new posts. And then write like an authentic, ideally, smart comment on their posts, particularly in that first hour that post goes live. You'd be surprised how helpful this is for starting to build your own following and getting your own impressions and just building a relationship with these thought leaders in your space that you want to emulate. So helpful, but very few people actually do it.
I find that leading with any sort of first-party data you have is a great idea. So the folks over at Tropic, I know their CEO, Justin, will put information on discounting or basically stuff related to getting deals done and which vendors are most in vogue, which ones are falling. You can't get that data anywhere else. His company has it. For me, what I try to do is survey my audience on things like AI adoption, on how their benchmarks are doing in the private quarterly report that I do on private companies. I think leading with data that you have and telling a story around it and having an image, that does well.
Yeah, I think original data is awesome. And I think to me, the images are even like as important or more important than the data itself, though. I think presenting that data infographic style, even if it's not really a true infographic, like what's interesting about that is that like it draws people in, lets them kind of like come to their own conclusion. Like the data itself tells a story that's compelling. And so people spend a lot more time looking at your post and really absorbing it. And that time on post tells LinkedIn it's a good post, like, and shows it to more people. And so infographic style visuals, screenshots that you then mark up in different ways do well. Another type of chart that actually does really, really well are called Sankey diagrams. Have you ever seen those?
I don't know how it was called, but I know what you're talking about.
I might mispronounce it too.
Yeah.
Those are those little river diagrams where it's like rivers feeding into a lake and then going back into rivers. A hire on my team who loved creating those. His name was Kurt. We called him the chartist internally before you poached him from me.
Sorry.
And so he started making those, and those would just crush on LinkedIn anytime he made them.
I have a question because you've probably actually reviewed the LinkedIn algorithm. Does it reward people for showing their face, even if it's for a completely unrelated thing? Because I keep seeing pictures of people. It's a post about net dollar retention rates, and then it's a photo of just their face in an airport with like some Cracker Jacks.
Images tend to do better than no images, but I think what happens when you post images like that, they end up getting a lot more like reactions, so likes, hearts, whatever, but then they end up actually not getting any more impressions than like a different kind of image. And so I think it's because people just like default to liking something when they see your face, but they don't necessarily read what you've written. And so it can certainly backfire on people, even if it looks like it works. But one thing, just as a kind of a pro tip for folks out there, when you have an image on your post, you can actually add links, and then those links won't unfurl in the post. Those actually end up allowing you to include links without getting as penalized for having a link in your post. So there's a little bit of a small hack to sneak that link in there without resorting to the whole link and comment strategy.
Wait, time out. Can you hyperlink the image?
You can't hyperlink the image, but you post the image and then you put in your post itself in the text, the link. And that way the algorithm treats it more favorably because it's not just posting the link.
Do you get penalized for hitting edit on a post if you do it 10 seconds after on purpose to put something in?
10 seconds after, if it's a tiny edit, like a typo that you're correcting, I don't see any issues with that. Otherwise, I tend to wait like an hour. Once an hour has passed, you can kind of edit it and there's going to be no difference because that first hour really makes a huge difference for whether the post takes off and starts getting shown to a lot more people or doesn't. And so a strategy that I do use sometimes is like, I'll have no link in the post. And then if the post does well, after an hour, I'll edit it and drop drop a link or two in there.
You answered my question. That's what I was getting at.
I see you. I think the other thing for me on LinkedIn is that you need to find a counterintuitive perspective. And so like there's a reason why this like 996 thing is a conversation. People love finding these things that are like a little bit controversial, a little bit out there that like create a conversation. And so you don't necessarily need to have a hot take on everything that's going to like polarize your audience, but you should have like, what is your perspective that nobody's saying and you're going to go to your grave defending? Or what's your pet peeve that people are still doing? Like, just what is that counterintuitive perspective that isn't being talked about everywhere else? Like, when you can hone your voice, that's what's really going to allow you to stand out.
I've also found that mentioning actual companies in your post helps. So recently, we were talking about it on the other podcast, the We're the Millers meme, where it's like, you guys are getting paid for this? I did that and put the company names on the meme. And recently, Ben, you'll probably see it on my LinkedIn. I don't think I've ever got that many impressions before. I got 335,000 impressions on this one. And it definitely helped that I used a pop culture reference. I was talking about a metric, ARR, and I tagged the companies in it. Now, some of the companies probably didn't like that, but nonetheless did well.
You're going to become a LinkedIn influencer after all.
I'm getting coached by one of the best.
The final thing I just share for folks is like you can repurpose your greatest hits. So you have this post that did really well. The odds are most of your audience didn't see it the first time around, or even if they did see it, if you post something similar again in a few months, they won't mind. They might still enjoy it. They kind of forgot about it before. So I waited so long. For the first like 5 years I was posting on LinkedIn, I never repeated content. And now when something does well, I try to refresh it and repost on like a 6-month cadence. I look for times when the idea or the content becomes topical again. And then I just, insert a different hook or have a slightly different angle, but you can repurpose the visual and, get more out of what already worked.
Did you see the CEO of Ramp replied yesterday to our critique of the graph?
To the y-axis crime? What did he say?
He explained that it was something too complicated for a guy like me to understand.
We're not doing a y-axis crime. You're just too dumb to understand our chart.
He didn't say it like that, but that was my interpretation of it. But their data probably is correct, but the whole point of a chart is to tell a story. And if you need to explain it, then you've lost the plot, right? It defeats the purpose of it.
Yeah, I think that we can extend an invitation for Eric to join this podcast to explain it in more depth if he wants to. You're welcome to join, Eric.
Yeah, maybe Kyle will try your product and tell people about it in the segment at the end. Kyle, anything else on LinkedIn for all the aspiring Kyle Poyas out there?
Final thing I just tell people is like keep to a consistent schedule of a couple posts a week. Like you don't need to worry about posting every single day. Like who has that much to say anyway? Like I certainly don't. But a few times a week keeps you top of mind for folks. And then I tend to post in the mornings, like 8:15 works well for me. And then surprisingly, my little secret is Sunday mornings work extremely well. I get generally more impressions, more engagement, more followers on Sundays than any other day. I have no idea why. I think that's just because the people who are obsessed are on LinkedIn on Sundays and ready to go, and there's not a whole lot of content out there for them.
Well, if the cycle of growth hacks proves correct, you just ruined Sunday mornings, I think, for everyone on LinkedIn.
Well, if you're on LinkedIn on a Sunday morning, your Sunday has probably already been ruined.
I was going to say, you hate your family. All right, Ben, what we got next, man?
Next up, we got a segment called Business Blunders. Now, I've learned my lesson. Kyle, I believe you have something to share.
Hey, CJ, did you hear that sound?
No, what's that?
It's the sound of yet another LinkedIn pitch slap.
I thought you were going to say opportunity knocking, but yes, I hear you.
That was the start of the pitch.
I don't know how many of these you get. So I'm now a solopreneur, meaning I am like the only employee at my company. And yet when I posted that last week, I got like hundreds of connection requests out of nowhere. And someone would just be like, congratulations, so awesome, want to follow along. And then as soon as I hit accept, they hit me with a pitch slap of, I'd love to sell you this product. And it just was like so out of left field and just so annoying. And I'm like a one employee business now. I can only imagine how many of these go to like a CFO or a head of marketing or a head of sales. Like These are just brutal.
You got to bring in the Rob Riggle from Step Bros, like,
They just knock you over the head with their pitch. It's terrible.
I got one that was, or when they lead with a compliment and then you keep scrolling down and it's gone quickly from saying how great you are to how great their product is. Somebody said they started it out, but the compliment was wrong. It said, we love what you're doing at Mostly Metrics is one of the most innovative AI tech companies out there. How do you feel about that, though? This is a real question. Do you unconnect with them after?
Oh, for some of them, it depends on how bad it is. Some of them I not only unconnect, but like I unconnect and block, which is like harsh, and I try to avoid that. But I just think for so many of them, just play it a little bit cooler. You could start with the compliment and then ask a question. Be like, hey, I've been talking to some other people in your space and have heard this comes up. Like, have you ever encountered this? Just like play it a little bit cool. Don't just like copy and paste your pitch and have it out of left field.
I think I also experienced something recently where I was trying to promote something. I ran out of in-mail credits. So then you have to connect with somebody and put the message in there. But at least be upfront about what you're messaging them about.
Yeah, if you're trying to sell something, like, and you put it in the connection request, like that way I know what your goal is before I accept it. I'm totally fine with that too. I'll probably click not interested for most of them, but it would get folks to the same result just a lot faster.
Here's a question. Is it better to respond to someone even if it's a cold email and just say not interested? Or as Grant Cardone would say, not interested is a level of interest.
So I think a lot of them want you to reply not interested because that looks like a reply so their email health actually looks better. Like it doesn't look like they're spamming people who are then like reporting it as spam. It looks like they're actually having like two-way conversations with people. So they would much rather you say you're not interested. For me, if it's a thoughtful, personalized email or like makes sense, I'll either reply not interested or I'll just ignore it. If it's a totally terrible one that just reads like spam or gets like basic information way off, I will sometimes report that.
Kyle, have you seen the video of this guy who set the 100-meter world record sprinting on all fours?
I saw it a few sent to me. That is one of the most confusing things I think that exists.
I think he needs a chiropractor after this. Looked like it hurt his back. But
How
either way,
can you not need a chiropractor after that?
and he's wearing gloves. That was the most fascinating part for more tactile grip.
But like, why did he do this?
He was clearly practicing for it too.
Yeah, at some point, these like obscure world records, like they just become like a thing. I mean, I've even seen tech companies be like, we're going to get the world record for most attendees at a hackathon. Why are people so obsessed about breaking obscure world records that nobody cares about?
Ben, at your last company, didn't you guys set a record for saying the word churn the most times? What's the story behind that?
I think it was at the time like a Mr. Beast style marketing where Mr. Beast in his earlier days would do things like counting to 1 million or counting to 1 billion. And so our founder, Patrick, was like, well, we should do that with churn because, PropWell, big product was about credit card churn and solving that. So yeah, I don't know if we officially got a plaque or a record or anything like that, but so Guinness, if you're out there, I'll take it. I mean, you can give it to me if you want.
I mean, CJ, do you know the story of like why the Guinness World Records are a thing?
No, but I want to know because I used to buy the books growing up at the school book fair.
So I asked ChatGPT about this. So this is, again, like a potentially reliable thing I read at 2 a.m. Apparently, it originated in 1951. Sir Hugh Beaver, the managing director of the Guinness Brewery, apparently that's the name of the person, he got into an argument at a hunting party about what is the fastest game bird. They just kept debating this, couldn't get to an answer, and he was convinced that let's create a book that'll just have these random facts and figures to solve pub arguments, and we could put them in the pub so that people have something to talk about as they're drinking beer, and then they're going to drink more beer. Apparently it was a huge hit, took off, and became an actual thing.
Do you know how many debates and arguments, even fistfights, I had with my college roommates over facts that no one could prove? Like, we needed this book back then.
And those probably only happened when you were sober, right?
Miller Lite was a sponsor of those events.
What do you think is more reliable, ChatGPT or Guinness.book-of-records.info/history.html?
Well, I mean, that's pretty legit. I mean, that's like
Probably
old
feeding
school
the
internet.
other.
If you wanted to publish a site like that, you were
Yeah.
serious about publishing.
I think this is like MLA format. Like you'd get the approval from your English lit teacher.
Like that took real work. No one vibe coded that app.
Kyle, would you ever try to set a world record? And what would it be?
I am not I'm not someone who cares about that at all. But if I were to do something, I guess maybe like most amount of cold brew per day. And I would like maybe try to go have as many different cold brew like options as I could within the course of 24 hours. I think I'd be pretty good at that.
Wow, that's intense. You would need some new organs after that.
Wait, we got some great names here. We got Gus Comstock is who you got to beat. Hugh Beaver, Gus Comstock. I mean,
I know the man I gotta beat.
Half the battle is knowing your competition.
talk to your doctor first before you do anything like this, I'd say.
Gus, if you want to come on the pod, let us know.
Next up, pricing in the real world. What's up?
CJ, have you ever taken a Waymo?
No, I've seen them in SF before, but I've never actually been in one. I didn't know how, like, because you can't flag it. Do you need an app or something?
I have not taken one either, but I read an Economist article about it, which is the most me thing I've ever said. Now have a 20% market share of like all ride hailing in San Francisco. And so I was like very curious about the economics of that. Like what happened to pricing now that we've got these Waymo self-driving cars? Like, are all these sort of taxi drivers, Uber drivers out of a job? Waymos are actually more expensive than cabs, and the overall spending has actually increased pretty dramatically. And people are spending more on cab drivers and Uber drivers, even as Waymos have gotten, 1/5 of the rideshare market.
This defies market logic, though. Why would you want to pay more to go in this if you could take an Uber? Or is it a supply and demand constraint?
See, I think this is so fascinating because for many AI products, we're talking about like how much cheaper should it be versus the human equivalent. And then here's Waymo saying, hold my beer, we're going to charge more. If I had to guess, people probably like that there's no awkward interaction with anyone else. Like you have the car to yourself. You can play whatever music you want. If you want to be on your laptop or doing whatever you want, like it is fair game. Plus, they are supposed to be safer. I don't know. That's what they claim.
My wife talks to every Uber driver, and I want to pay her 20% more to stop talking to every Uber driver.
Next up, we got something I tried this week. Folks will try something. Kyle will try something. CJ will try something. Maybe even I'll try something. Just email ben@mostlymetrics.com. But this week, what do we got, Kyle?
Dante's Inferno says there are 9 circles of hell. But I'm here to tell you, Dante never had to figure out international sales tax. This is, to me, one of the biggest downsides of solopreneur life. And my thing I tried this week was being compliant on international taxes. And I'll give you like the specifics. I had someone start subscribing to my newsletter from Saudi Arabia, which is great. Shout out. $15 a month. And now I got to figure out how to be tax compliant in Saudi Arabia, which apparently you need to start registering yourself as soon as you have one transaction in the region. So Stripe goes, hey, we got this app that you can use that'll automate the process. So I take Stripe and then it takes me to an app called Taxtually. And then Taxtually says, oh, we actually have this other partner app that you also use called LumaTax. And then LumaTax goes, we actually also have this other app that we use called Avalara. And now I'm in like this Russian nesting doll of apps to figure out taxes that are gonna now cost me like way more money than I'm even making from this one subscriber. Someone's got to figure this out.
I mean, first problem, $15 a month. They got that oil money over there, Kyle. You got to get those are rookie numbers. You got to get your
need
numbers
some
up
pricing
over
help.
there.
Truly. What do you do for taxes, CJ?
I just figure they'll reach out in a very friendly way once I owe them something.
Wait, you're a CFO that's just winging it?
Sometimes you just gotta, it seems like more of a them problem at this point over in Saudi Arabia, you know? There's gotta be like a de minimis amount, right? It's not like you're doing 50 grand a month over in Saudi Arabia and you need to, maybe you are, maybe growth
No, I'm
truly is
doing
unhinged.
$15 a month.
Because it makes no economical sense then to even allow somebody to purchase from over there. So don't overthink it, man. Not that this is tax advice.
So if your name is Andrew Davies, the Chief Innovation Officer of Paddle, and you wanted to try Paddle, maybe hit up ben@mostlymetrics.com. I don't know.
Do it, Andrew.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe. Give us 5 stars or hit like. The algorithm overlords thank you. Drink water, call your mom, and have a great day.